In 2019, Nigeria introduced one of its most ambitious tax reforms in decades. The Finance Act 2019 wasn't just a policy update, it was a sweeping reform that amended 7 major tax laws. The amendment was aimed at modernizing Nigeria's outdated tax system, expanding the digital economic tax reach, and boosting government revenue without overburdening citizens. The bill was presented by former President Muhammadu Buhari alongside the Appropriation Bill 2020 to a joint session of the National Assembly on 14th October 2019 and signed into law on 13th January 2020. The 7 tax laws that were amended include 1. Companies Income Tax Act, 2. Value Added Tax Act, 3. Customs and Excise Tariff Consolidation Act, 4. Personal Income Tax Act, 5. Capital Gain Tax Act, 6. Stamp Duties Act, 7. Petroleum Profit Tax Act. In this video, we will break down the core amendments of the Finance Act 2019 by considering what changed and why it matters for Nigeria's economic future. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of taxmobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Let's consider the major amendments under each tax law. 1. Companies Income Tax Act. Exclusions from taxation. To reduce double taxation, the Finance Act excluded profits already taxed under capital gain tax, petroleum profit tax, and personal income tax from companies' income tax. The list of tax-exempt income was also expanded to include profits of small companies, income from exports, if proceeds are reinvested in raw materials, plants, equipment, and spare parts, dividends and rental income earned by real estate investment companies, dividends paid under regulated securities lending transactions. Deductions. New allowable deductions include dividends distributed by real estate investment companies, compensating payments treated as interest in securities lending. Disallowed deductions now include expenses from related party transactions that lack economic substance, expenses related to tax-exempt income, penalties for statutory violations, taxes or penalties paid on behalf of another entity. Simplified approval for management fees. Ministerial approval is no longer required for management fees paid between non-related parties. Mandatory tax identification number. 10. All companies are now required to display their tax identification number on business documents. Have a TIN to open or operate a business bank account. Taxable digital services. Foreign companies providing digital management, consultancy, or technical services to Nigerians are now taxable if they have a significant economic presence. Insurance sector reforms. Here, taxation rules were made clearer. 1. Only investment income from shareholders' funds is taxable. 2. The 4-year cap on loss carry forward has been removed. 3. A minimum tax of 0.5% of gross premium was introduced. Excess dividend tax. Dividends from the following are now exempt. 1. Retained earnings. 2. Tax-exempt income. 3. Frank investment income. 4. Real estate investment contribution distributions. Incentives. Agricultural companies now enjoy an initial 5-year tax holiday, renewable for 3 more years. Early tax filers get tax credits of 2% for medium-sized companies and 1% for others. Other changes include assessment year now based on the company's accounting year, not the calendar year. Companies can request to pay taxes in approved installments. Reduced tax rates. Small companies with annual turnover of less than 25 million naira is now exempted from tax under the Companies Income Tax Act. Medium companies with annual turnover of 25 million to 100 million is now subject to tax at 20% under the Companies Income Tax Act. Large companies with annual turnover of 100 million naira and above is subject to tax at 30% under Companies Income Tax Act. Foreign loan exemptions adjusted. Maximum exemption now capped at 70% with maturities over 7 years and a minimum 2-year moratorium. Thin capitalization rule. Interest exceeding 30% of EBITDA from related party foreign debts is disallowed. Petroleum Profit Tax Act. The Act repealed the prohibition on taxing dividends paid from profits already subjected to petroleum profit tax. Now, personal income tax and capital gain tax can be levied on such distribution. Personal Income Tax Act. The term Federal Board of Inland Revenue was replaced with Federal Inland Revenue Service. Pension deductions was simplified by abolishing the requirement for board approval. Harmonization of references was made throughout the Act. Value Added Tax Act. VAT rate was increased from 5% to 7.5%. Registration requirement under VAT Act. 1. Mandatory VAT registration is now enforced. 2. Non-registration penalties increased to 50,000 naira for the first month and 25,000 for each subsequent month. VAT for non-resident companies. Non-resident companies must charge VAT on invoices, and Nigerian recipients must withhold and remit VAT directly to Federal Inland Revenue Service. VAT threshold. Companies with annual turnover below 25 million are exempt from VAT. Penalties. 10% penalty on unpaid VAT plus Central Bank of Nigeria's minimum with discount interest rates. Higher penalties for failure to change address, notify cessation of business, or file VAT returns. New exemptions. Exempted goods include locally manufactured sanitary towels, pads, tampons. Exempted services include nursery, primary, secondary, and tertiary tuition. Customs and Excise Tariff Act. Certain imported goods listed in the 5th schedule now attract excise duties. Capital gain tax. Exemption from CGT where businesses are restructured for better organization with a restriction on asset disposal within 365 days. Compensation for loss of employment below 10 million naira is now exempt from CGT. Stamp Duties Act. Updated definitions. Stamps now include electronic stamps. Instruments now include electronic documents. Duty on electronic transfers. Electronic money transfers of 10,000 naira and above attract a 50 naira one-off stamp duty. Exemptions apply for intra-account transfers within the same bank. In summary, the Finance Act 2019 introduced Nigeria's most significant tax reforms in decades, achieving 1. Broader tax base without necessarily increasing overall tax burden. 2. Greater fiscal equity between sectors and company sizes. 3. Encouragement of investment in agriculture, technology, and manufacturing. 4. Alignment of Nigeria's tax system with global digital economic trends. 5. Improved administration and revenue generation through stricter compliance mechanisms. Ultimately, it represents a crucial step in making Nigeria's tax system simpler, fairer, and more competitive globally. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.